Good morning, everybody. Welcome to today's webinar featuring Gold Royalty Corporation. My name is Jim McDonald. As a quick reminder, Gold Royalty is a royalty company with a North American focused portfolio of more than 240 royalties and streams, anchored by a 3% NSR royalty on Odyssey, the underground portion of the Canadian Malartic mine, Canada's largest gold mine. Company trades on the New York Stock Exchange under the ticker symbol GROY. And joining me today from the company, I've got David Garofalo, the company's president and CEO, and Jackie Presbolowski, vice president, capital markets. Before turning the call over to David and Jackie, I just want to go through logistics fairly quickly. Nothing new here for those who have been on calls with me in the past, but just a quick reminder. Our webinars are intended to replicate and be comparable to our in-person meetings, which we like and encourage to be as interactive as possible. With that in mind, if you have questions along the way, please feel free to ask them. The best way to do so is use the navigation pane at the bottom of the screen, click on the Q&A or the chat button. One of us will see that and get those questions presented and then answered. If for some reason your question does not get asked right away, it's not that we don't see it or are ignoring it. It's simply that we know that the answer to that question is going to come up in the next one or two slides, and we're going to let the normal course of the presentation get that answered for you. Alternatively, if you want to speak to David, Jackie, or Peter at any point during the call, we welcome that as well. Again, the only way to do that is, again, use the navigation pane at the bottom of the screen, click on the raise hand button. We will be able to see that, and then unmute your microphone and allow for direct conversation back and forth. As with all of our calls, I will remain on throughout, but for now, we'll remove myself from both video and audio so as not to be a distraction. Enjoy the presentation with Gold Royalty, and I will turn the controls over to David Garofalo.
Well, good morning, everybody, or good afternoon, as the case may be. Thanks for joining us today. I'll see if I can advance the slide deck here, Jim, and get started. Just one moment, and we'll get into it. What I will do while Jim's loading up the slide deck is spend a little bit of time talking about gold fundamentals and how our investment thesis in Gold Royalty Corp, I think, is ideally suited to optimize leverage of the gold price as we expect it'll go up over the coming years with much more firmly entrenched inflation than what we've experienced in past cycles, as we've experienced over the last several years with a massive expansion of money supply. But if you look at gold over a 50-year horizon, and Jim, I'm sorry, I'm not seeing the slide deck, and I'm wondering if it's my.
Dave, I'll pop it up here. So
Okay, thank you
apologies for
very
that.
much. Sorry for the delay.
Jim, if you could just provide me.
Yep,
Yes,
you should
thank
be
you.
good to go, Peter.
Yeah, perfect. There we go, David.
There we go. And Peter, are you advancing it, or shall I?
Yep.
You'll advance. So maybe you can just spend a minute talking about gold price fundamentals first before I get into the presentation on Gold Royalty Corp. Do we still have the slide here on gold performance over a 50-year horizon, or is this the most recent presentation?
This is a more firm specific.
Okay, well, I can talk to it verbally. And I think before I get into the highlights of our story, what I wanted to talk a little bit about how gold has performed over a 50-year horizon, really since gold abandoned, or the US government abandoned the gold standard back in the early 1970s. And really, gold has been a one-way trade over that 50-year horizon, going from $35 an ounce to over $2,800 an ounce most recently, as it achieved an all-time nominal high. And over that period of time, we've also seen the purchasing power of the US dollar, and for that matter, most fiat currencies decline by upwards of about 96, 97%. So the temptation for US government and for, frankly, central banks globally in the Western world is to continue to expand money supply in the absence of having the tether to the gold standard as we experienced in the earlier part of the 20th century. And so gold is the one currency you can't print. It can't be manipulated. It isn't the obligation of any government. And why it's performed so well in its most recent 4 or 5 years is because we've seen a massive expansion of money supply, really going back to the great financial crisis. It's unprecedented. And what I think is likely to happen is a continued expansion of money supply, notwithstanding the fact that we actually started to see nominal rates pivot over the last several months. We are starting to see more pronounced inflation, likely to be more deeply entrenched, and certainly in the interests of central banks and governments globally to see inflation actually, increase in momentum, because we've never seen debt levels today as we've seen in the past. Today, we're seeing global debt to GDP of about 350%. In the last large inflation cycle we saw in the 1970s, global debt to GDP was only 100%. So there's very limited scope for central banks to expand money supply or to expand debt levels and increase interest rates significantly. And so we're likely to see inflation accelerate. And gold is really an accurate, agnostic barometer of what's really happening in inflation. And I think nobody on this phone is experiencing 2 to 3% inflation. We're all experiencing double digit in our everyday lives if we're buying shelter, food, or fuel. And so those are really the big consumers of our pocketbooks. And it's in the interest of central banks to see inflation entrench in order to inflate debt away, because there's no fiscally responsible way to deal with the massive amounts of government debt that's been piled on, and for that matter, at the corporate and individual level as well. So in that light, if you buy into the investment thesis for gold, I think the question you have to ask yourself as an investor, where are you best placed to get optimum leverage to the gold price? And unfortunately, in the producer universe, in the gold equities, they're experiencing significant inflation in their input costs, whether it's capital operating costs. And we've seen evidence of that in the most recent quarterly results for some of the biggest producers in the world, namely Barrick and Newmont. And we've seen a significant underperformance of their equities relative to the commodity because of the concern of the overhang of inflation. And what exasperates the underperformance is the fact that the global producer universe is shrinking as reserves have been declining for over a dozen years due to the lack of exploration and reinvestment back in the ground to replace depleting reserves. So we're seeing the combined forces of declining reserves and increased operating costs undermine the leverage propositions that producers should be providing you. And I think where you're best placed to get optimum leverage to the gold price is, frankly, in the royalty universe, which is what the gold royalty model offers you. It's top line exposure. We have over 240 royalties in the portfolio, and those 240 royalties are almost exclusively on gross revenue. So that means that we are exposed to the revenue at the mine site with complete insulation from operating capital cost inflation. So it's top line exposure. So that means that our margins are unmitigated by inflation at the mine site level. And so you get full exposure to the gold price within a vehicle like Gold Royalty Corp. And not only that, we offer significant diversification, which no operating company can hope to achieve, with over 240 royalties. And you're looking at nearly half of the company here, and Jackie, myself, and Peter. We have a scalable model, and we could run a portfolio of 10 times the size with the same number of people. So that means every incremental dollar of revenue growth goes right to the bottom line. And this year is an auspicious year for Gold Royalty Corp because we're at a free cash flow inflection point. Having only IPO 3.5 years ago, we've gone from a startup with no revenue to actually almost tripling our revenue this year, in the first full year of positive operating cash flow, and significant cash flow growth right through the end of the decade, organic growth from a royalty of over 240 royalties that are completely bought and paid for. We have 60% compounded annual growth in our revenue right through the end of the decade. And as I said, that incremental revenue falls right to the bottom line and puts us in an excellent position to start returning capital to shareholders in various forms. And while we have significant optionality in that portfolio, we also have some of the largest scale mines within North America that we have royalties on. In fact, 3 of the 5 biggest producing gold mines are in North America within our royalty portfolio, namely Canadian Malartic in northwestern Quebec, operated by Agnico Eagle, the 3rd biggest operator in the world. We have a royalty on Côté, which will be Canada's second biggest producing gold mine as it achieves commercial production in the fourth quarter of this year. And we have a royalty on the underground extension of Goldstrike, which is North America's biggest producing gold mine, operated by two of the three biggest gold producers in the world, Barrick and Newmont. So it's not only a diversification strategy, we have a quality proposition with royalties on some of the longest life, largest scale operations of the world with some of the best capitalized operators. So it's not only quantity and diversification proposition, it's a quality proposition. And the reason we've been able to grow this royalty portfolio out so quickly and dramatically and delivered peer-leading growth in revenue is because of the quality and tenure of our board of management. Collectively, we have over 400 years of industry experience within our board of management, which gives us two distinct advantages. One is gives us a clear-eyed view of the underlying risk of what we're investing in. Because like myself, many of my board of management have been in operating and mine development roles. So we understand the inherent risk of what we're investing in, and we can price that risk appropriately so we can get an adequate rate of return on the capital we're allocating to the royalty opportunities we have. But not only that, we have access to virtually everybody in the industry because many of us have been operating in a large cap environment. So we have a network that's second to none in the royalty space. And that's allowed us to accumulate a royalty portfolio effectively on an exclusive basis. We haven't been in competitive processes in any of the acquisitions we made, which means we can price things without the competitive pressure that some of our peers face, so we can get an adequate rate of return on the capital we invest in new royalty opportunities. We can go to the next slide, Peter.
Hey,
Thank you.
David, if I can interrupt you. I got a couple of questions that came in.
Sure.
Um, excuse me. So actually sort of both along the same line, so I'll go with the second one. What is the company's stock performance beta correlation to the price of gold, to the price of gold? And even with your long-term positive outlook on gold prices, do you do any short-term commodity price hedging?
Yeah, well, I'll answer the second question first. We do not do any commodity price hedging. That really undermines the leverage proposition that we think investors are looking for in gold equities. We're not financial engineers, we're mining engineers. We're builders and operators, and we leave the financial engineering to the investors. If they choose to hedge their gold exposure, they can do so quite readily. It's a very liquid commodity, easy to hedge. That's not what we're paid for. We're paid to optimize the leverage to the commodity through our diversified portfolio and also through the exploration that our operating partners are undertaking. Typically, our operating partners on our royalty portfolio invest over $200 million per annum in grassroots exploration and brownfield exploration around their existing portfolio. And that allows us to not only offer optimum leverage to the gold price, but unmitigated leverage to the exploration of underlying operators. And just to be clear, as a result of this model, given that our royalties are completely bought and paid for, that exploration expenditure comes completely free to our shareholders. So I think the important thing here is offering, again, unmitigated leverage to the gold price, unmitigated leverage to the exploration success of our underlying operators while maintaining a very low cost structure and a very high margin business. In terms of leverage to the gold price or beta to the gold price, if you will, typically royalty companies have demonstrated that over time they offer far better performance to the gold price, both in ups and downs in the cycle. So I would say the beta is higher. But I have Jackie on the phone, who until recently was a senior mining analyst at BMO, and I think can offer a more learned response on her observations on that.
Thanks, Dave. So yeah, I mean, the leverage to the gold price, it really depends on which direction the gold price is going. Certainly, when gold prices are going up, royalty companies can offer more leverage to the gold price because we don't have cost inflation, which tends to go up at the same time as gold prices go up. Of course, there's going to be some times where costs are more sticky and gold prices are higher, and in those maybe brief periods, the operators or developers would probably have more leverage to gold, but kind of longer term or over most of that cycle, we're going to see more leverage to gold on the royalty streamer side because our costs are fixed or essentially zero in the case of many royalties. So I think that probably gives us an advantage in this strong gold price environment, especially as we go into the beginning of 2025, when gold companies are going to be reviewing which cutoff grades, which gold prices they use in their mine plans for the next year. We could see a bit of a step change or a catch up in costs as gold companies raise their costs, mine more low grade material, and they can get away with that. They can do that because gold prices have been high, but it will again impact their leverage to gold and not ours as much.
Fantastic. Appreciate that. No more questions currently. I'll let you get back to the presentation.
Well, at this point, I'm going to hand it over to Peter to talk through some of our portfolio in a bit more detail and how we built it up, and then I'll come back to sum up. Peter, over to you.
Thanks, Dave. Taking a step back over the last 3.5 years, Gold Royalty started in March of 2021 as a public company with a maiden portfolio of 18 royalties on high quality, large scale development assets. And at that time, we had no clear line of sight to immediate revenue. Realizing we had a strong balance sheet and a strong currency, we started consolidating the sector through the balance of 2021, acquiring 3 other public royalty companies: Ely Gold, Golden Valley, and Abitibi. This brought us, importantly, cash flow into the portfolio and a strong anchor position in Quebec, Ontario, and Nevada, very strong mining jurisdictions. Since that wave of corporate consolidation, we've had to be more targeted in continuing to grow the portfolio, completing third-party single royalty acquisitions, as well as select royalty financing situations. As we sit today, we have over 240 royalties with, as David mentioned, the most robust revenue growth profile within the royalty and streaming sector. A snapshot of our portfolio highlights our 7 cash flowing royalties currently, another dozen or so at various stages of development, and that long tail of optionality, which we benefit from for free with no associated exploration or expansion costs for us as a royalty holder. From a qualitative standpoint, and as I mentioned, we have an anchored position in the best mining jurisdictions in the world: Canada and the USA, specifically Quebec, Ontario, and Nevada. I'd also highlight that our key cornerstone assets, 3 of the 5 largest gold mines in Canada and the USA, are being developed and driven forward by the largest mining companies in the sector, the likes of Newmont, Barrick, and Agnico, which not only bring the technical expertise to move those assets forward, but have the balance sheets and capitalization to continue to invest, expand, and explore those projects to extend mine lives and increase annual production rates, which benefits us as a royalty holder. All in all, and the outlook for the portfolio out towards the end of the decade, our revenue profile is really at this key inflection point. From just over $5 million in revenue, and my slide's a bit slow here, so I'll try and get back to our revenue forecast slide. But to speak to it, we had just over $5 million in revenue in 2023. Our guidance for 2024 is almost a tripling of that, with $14 million in expected revenue this year. We have achieved $9 million in total revenue, land agreement, and option proceeds through the first 3 quarters, so we're well on track to achieving that guidance, as we have a few key assets, specifically Varus and Côté, ramping up at the end of the year. Towards the end of the decade, as assets such as Odyssey, going to be Canada's largest underground gold mine, where we have a 3% royalty, is ramping up towards 2028, we expect to see this significant growth profile very likely be achieved. Give me one moment as I wait for my computer to catch up. Here we are. As I mentioned, a key inflection point for Gold Royalty from 2023 to 2024, and then that doubling again, looking out towards 2025. The chart here, the columns on the bottom show the gold equivalent ounce production profile. So how many gold equivalent ounces we are expecting to receive at Gold Royalty Corp. And this is based on analyst consensus estimates for the 6 analysts that cover us. The lines that you see are that gold equivalent ounce production profile sensitized to various commodity prices. So whether you view the gold price to be $2,000 an ounce or upwards of $3,000 an ounce out towards the end of the decade, you can see even at the lower end, we're achieving very strong firm-specific revenue growth. And importantly, a very important aspect of the royalty and streaming model is this revenue growth is against a completely fixed cost structure. We achieve approximately $7 to $8 million in fixed cash operating expenses to run our business, and we expect to maintain that as this revenue growth profile is achieved, meaning each incremental dollar of revenue growth is translating into free cash flow growth and will give us the latitude, as David mentioned previously, to evaluate different types of capital distributions to shareholders in the future. Despite this, Gold Royalty is at an undervalued position relative to peers, and we primarily attribute this to that key inflection point I spoke to earlier. In 2023, we were not covering overheads. We were a cash burning business. And in 2024, we are now recognizing our first year of positive free cash flow and starting to bolster our balance sheet. Through 2025 and 2026, as I mentioned, we see significant free cash flow growth, a much stronger financial position, and we believe this will be a strong catalyst to re-rate our valuation back in line with peers, closer to 1x net asset value relative to the 0.5x net asset value that we currently trade at. I mentioned it briefly before, but speaking to those catalysts, what is really driving this growth in the near, medium, and long term? Q4 in 2024 and Q1 of 2025, we see three key assets really ramping up. The Côté Gold Mine is going to be Canada's third largest gold mine once fully ramped up. They're on track to end the year at 90% of mill throughput, and that team is delivering quite exceptionally on the project in Ontario. We have a 0.75% NSR over the southern portion of Côté. On a similar timeline as our most recent acquisition, Varus. This is a high-grade zinc silver mine in Europe, and it's on track to end the year achieving commercial production and ramping up through 2025 as well. We hold 100% copper stream. We benefit from 100% of the copper production at Varus. And then finally, I'd highlight Borborema. We hold a 2% NSR over this development stage gold project in Brazil, which is on track for initial production in early 2025. That project is well advanced, close to 60% complete construction as of the end of Q3. Looking out over the next 2 years, we see several assets ramping up in Nevada, specifically County Line and Granite Creek, high-grade operations through Nevada, which are being developed and permitted to complete and ramp up production over the next few years, which we're excited to see could supplement our revenue profile. And then our cornerstone asset, which I've already mentioned previously, Odyssey, the largest underground gold mine in Canada, already achieving initial production, but will really ramp up towards 2028 when production from the shaft commences and the Canadian Malartic Complex shifts to a fully underground operation. With 240 plus assets, I can wax poetic on several of them and what we're excited about in the long run and the optionality there. But as you can see, there are several near-term catalysts that are really driving that growth and improving the fundamentals of the company. So with that, David, perhaps I'd pass it back to you to talk about some of the nuts and bolts, share structure and strategic backers of the company before opening it up for more Q&A.
Yeah, great idea, Peter. Maybe you could bring up the cap table and I'll talk to that. Well, maybe on share ownership first. 20% is held by insiders. We have a significant number of strategic shareholders as well, own about 10%, and that includes Gold Mining Inc., which is the company we were spun out of back in March of 2021. They still own 12.5%. Nevada Gold Mines, which is the joint venture between Barrick and Newmont, is our second biggest shareholder at 5%. And that was by virtue of an acquisition of non-core royalties we picked up in Nevada from them a couple of years ago. Again, that speaks to the relationships and leveraging those relationships to acquire royalties on a preferential basis. The head of strategy at Barrick used to be my lawyer back at Agnico Eagle when I was CFO there. So leverage a relationship there to get into the door before our competitors were even aware that royalty package was available. And in doing so, brought in two of the biggest gold miners as a strategic shareholder in the company. Orion came in as a result of the Varus acquisition. Orion is the biggest mining private equity outfit in the world based out of New York. And they are at a 2.5% ownership as a result of the Varus acquisition we made earlier in the year and that copper stream in Europe. And as you can see, we've been able to acquire a very impressive roster of strategic and institutional shareholders since our inception back in March of 2021. When you look at our cap structure, not terribly complicated. We have 169 million shares outstanding, 199 million shares on a fully diluted basis. The biggest component of that dilution is the the warrants that we have outstanding. They're 3-year warrants that mature in May of 2027. They're struck at 225 per share. Otherwise, there's virtually no dilutive elements within our share structure. In terms of sell-side research coverage, we have 6 analysts that cover us. And as you can see, they represent some of the largest cap Canadian banks and also some significant institutional coverage within the US from Raymond James and H.C. Wainwright. In terms of our firepower, we have about $5 million of cash on the balance sheet and $10 million available under our revolving credit line with BMO and National Bank Financial. Otherwise, our balance sheet is quite clean. The convertibles are non-unsecured 5-year convertibles with 7% cash coupon. So a very attractive piece of paper, and they don't mature until 2028. So with that, Jim, be happy to take any other questions that might be coming from our listeners today.
Sure. Thanks everybody for the presentation. And just a reminder for people on today's call, if you do have questions, please use the navigation pane at the bottom of the screen, click on the Q&A or the chat button. We'll get those answered for you. So first question in the queue, do you have much exposure to copper? And then follow up to that is, should you, and I guess should you means either more or some.
Yeah, I'll take that one, Jim. So currently within the portfolio on an asset value basis, we're still about 90% gold, a touch under 10% copper. In the near term, we do have a larger proportion of revenue reporting in as copper, specifically as the Varus copper stream ramps up in 2025. But as assets like Cote and Odyssey really ramp up in later years, we'll balance out closer to that 90-10 proportion. With regards to how we look at commodity mix going forward, we'll always maintain vast majority in terms of precious metals, that being gold and silver, targeting 75 to 80% as a minimum. The balance of the portfolio, we will look at other base metals, liquid LME traded metals, specifically zinc, nickel, lead, and copper. We're quite bullish on copper. And often we'll gain that exposure to those commodities in polymetallic settings, that being gold, copper porphyries, or gold-bearing VMS deposits, given the robust economics that type of deposit typically delivers. So you'll always see us provide that primarily precious metals exposure, but we will look for high quality cash flowing opportunities in those commodities that we have a strong understanding in.
All right, I appreciate that, and makes sense. As part of that, what are your thoughts? And you can open this up to either you, Peter, or anybody else too. What are your thoughts on the copper price? I know it's had a little bit of a pullback here, but do you expect it to be higher, significantly higher going forward?
Yeah, look, I think the demand supply fundamentals are as robust as they've ever been. When you look at the demand side of the equation, the electrification of vehicles and the infrastructure required to support the electrification of vehicles in the Western world, we're looking for fully EV environments by 2035 by government mandate. That requires almost an exponential growth in demand. But there isn't a resultant source of supply, particularly given the significant amount of underinvestment and exploration over the last decade or so. The juniors do all the heavy lifting in grassroots exploration, and they haven't had consistent access to capital markets for at least a dozen years. And that's true in both the gold and the copper side. So as a result, we just have not seen that kind of pipeline growth that's required in terms of development stage assets to support the supply required to meet the demand. There's likely to be a continued and burgeoning increase in the supply deficit, which will drive copper prices to much higher levels. The lack of investment in exploration and development tells you that we're not nearly high enough to provide incentive pricing for the necessary exploration and development required to meet the burgeoning demand. So we're likely to see double-digit copper prices well north of $10 a pound to incentivize the necessary exploration and development required to meet societal needs for copper.
Okay, just following up on that, double-digit copper pricing, without a crystal ball, what would be your timing on something like that?
Well, given that we have some interim benchmarks in terms of meeting the electrification requirements on the vehicle side and the infrastructure necessary to do that, I say within the next 3 to 5 years is entirely reasonable in terms of achieving $8 to $10 a pound copper.
Yep. Fantastic. Appreciate that. Can you explain land agreement proceeds?
Over to Peter.
Peter, you're on mute if you're trying to talk.
Thanks, Jim. Yeah, so to cover off land agreement proceeds, this is a portion of our revenue that comes from our royalty generator model, which is an aspect of growth that's somewhat unique to us. I'll zoom out, and we have four main legs of growth in how we grow our business. I spoke to corporate M&A, acquiring third-party royalties, so picking up royalties from other corporates or prospectors, and also providing royalty financing as our third leg. The royalty generator model is something we inherited from Ely Gold Royalties and Golden Valley Mines and Royalties, the companies we acquired in 2021. And with those companies, we didn't just acquire a great portfolio of assets. We brought in the human capital in those businesses, specifically in Nevada, a gentleman named Jerry Bauman. What Jerry does is he goes out and he stakes claims almost somewhat predatorily around existing operations and scours the Bureau of Land Management to find opportunities where we can pick up prospective packages of land. Once we have those packages, we'll knock on our neighbor's door and offer up to sell that land package, which is of critical importance to them, and sell on that land package. But rather than looking for top monetary dollar up front, our objective is to retain a royalty on the back end of those land sales. But we will incur some cash proceeds when we sell those land packages, and that's what the land agreement proceeds is in our financial statements and is part of our revenue. We've consistently generated between $2 to $3 million a year in annual revenue through this model. So it really pays for itself, covers almost half of our G&A, and is a continuous way for us to continue to add the number of royalties we have in our portfolio at an extremely low cost. It's really just Jerry's sweat equity. There's no associated costs with acquiring those early stage royalties.
So, question follow up on that then, Peter. Is that unique to Gold Royalty in the sense that you're, potentially smaller and more nimble than some of the other groups out there, or is that something that, the bigger guys are doing as well?
It is something that is unique to our business. You will see some other royalty generation models at companies, and I think an important distinction of our model is we do not spend any money on exploration or investing in these assets. We simply acquire land packages and sell them on to operators. And it does take a nimble entrepreneurial team to be able to execute that model.
Yeah, I think it bears emphasizing that we don't take exploration risk. That's really not part of the model. We're a pure play royalty company. So to emphasize what Peter said, again, it's unmitigated leverage to the gold price. Because if we take on exploration risk, then we're exposing our shareholders to inflation risk that comes with those exploration expenditures. But again, our cost structure is flat, stable, and that incremental revenue growth that comes from higher gold prices and the volume growth that we expect from this prolific portfolio really falls right to the bottom line.
Excellent. Thank you. Next question. Can investors expect a dividend, and what's the potential timing if that's the case?
Look, I think we're at a point where in late 2025, where we paid down some of our revolving credit facility, we're in a position to look at returns of capital in various forms, whether that's a dividend, a share buyback. It's really what's the most accretive way to allocate that capital to shareholders. But, I know that our board is very excited about returning capital to shareholders, which is really remarkable given the relative youth of this company. Again, only having IPO'd in March of 2021, to get to a point where we're actually talking about a dividend 3.5 years later, or a return of capital in some form, I think is a remarkable achievement.
Would wholeheartedly agree with that. And there's a lot of companies out there that sort of promise and never deliver. But so yeah, to see that at some point in the next, even if it's not 2025, it's soon after that, that would be fantastic. Next question. Are you a target for acquisition given your assets and where you're trading?
It's an excellent question. What I would say, and Peter, I think, emphasized this in the chart that showed the price and net asset value multiples. There are many companies that have significantly higher premium multiples to ours, and I think that's a function of scale. Some of those companies have been in the space much longer and have already realized some of their growth or their X growth, if you will. And we think there's likely to be consolidation among the smaller cap players in order to capture that type of multiple that comes from the scale and trading liquidity. What I can't predict is the sequencing, who the survivors will be. Ultimately, it's the shareholders that decide, but I think consolidation is inevitable. And in fact, since our IPO, we've rolled up three of our competitors when we had the currency to do that. That's been a significant pillar of our growth in the early part of our tenure back in 2021. We had a much higher share price and multiple. But I think since then, we've been much more disciplined in our focus on individual royalty acquisitions, royalty generation, project financing that we know we can do accretively. But there's been a dozen companies that have disappeared in consolidation since our IPO, three of which we've absorbed. And there's likely to be more consolidation going forward, given the attractiveness of scale and the premium multiple that seems to afford some of the larger cap peers in our space. So there will be consolidation. What I can't predict is who's going to be surviving, who's going to be taken over, but it'll happen for sure.
Okay. Good information. Are you currently in any indices? And is there a consensus share price target from the analysts that are covering you?
Yeah, Peter or Jackie, do you want to cover that?
Yeah, sure. So we are in the GDXJ index. So that's the index that Van Eck runs for the smaller gold mining companies. So we are in that index GDXJ. In terms of analyst coverage, like was mentioned before, we have 6 analysts covering us. They all have an outperform or a buy rating on our stock, and the average target price is about $3.25 US. So significant upside to our current share price, definitely across all of the analysts that cover us.
And for those on today's call, I do have copies of some of those reports, and I can distribute those afterwards. If there's any updates, Jackie, Peter, David, please forward to me if there are any updates on those recently. And then the next question.
I'll just say we reported our earnings on November 5th, so I can send you the research that came out after that.
Perfect. Thank you so much. Next question. Has transaction volume for gold royalties picked up in the past year, and what do you consider in selling a portfolio royalty?
Well, we don't sell our royalties. I mean, royalties run with the land, so they provide infinite optionality. We've already paid for them. So it definitely pays to be patient, given the holding costs are basically negligible or zero. So it's infinite optionality with zero cost once you own them. So selling royalties is really not in the cards for us. What I would say is the pace of acquisition has slowed considerably since 2021. We were very aggressive in 2021 in consolidating some of our peers. We pursued a roll-up strategy after a very successful IPO. We had a north of $5 share price. We IPO'd at 5, ran to $7 per share, recognized that we had a premium multiple, and we used it to our advantage in terms of growing our portfolio from 18 royalties initially to well over 190 royalties as a result of that roll-up strategy. After the Federal Reserve started tightening in early 2022, we saw a significant derating of gold equities, and in particular, our story, because we had the best growth profile in the sector, and growth was being significantly discounted in a rising interest rate environment. So we stopped doing M&A. We had to exert significant discipline, and we started to focus on, again, royalty generation, which is negligible cost for us because it's organic. We've done some limited project financing, and we've also done some third-party royalty acquisition. So we've been much more discerning in terms of our acquisitions since 2021 because we simply haven't had the currency to go out and transact in a significant fashion. So we've had to be extremely disciplined to ensure that we continue to deliver accretive growth to our shareholders. So it's been a much slower pace of acquisition since 2021.
Appreciate that, David. Just a reminder too, again, for people on the call, if you have questions or comments, please use the navigation pane at the bottom of the screen. Click on the Q&A or the chat. We'll get those answered for you. Currently, there's nothing there's nothing in the queue right now. So as we potentially think to wrap it up, I have a couple of questions that I'd like to ask. Two questions that I sort of opposite of each other, but you've probably heard me ask you before. And you can pick either order and how to answer this. So one, what keeps you up at night? And two, what are you most excited about?
Well, the thing that keeps us up at night is really finding ways to creatively grow. As I said, when we had the currency back in 2021, we could be aggressive because we had the multiple advantage. Since then, we've had to be much more discerning and selective in terms of what we've acquired. And so keeping that pipeline full is a constant preoccupation for my team. And I think we've done an exceptional job of picking up some quality assets over the course of the last couple of years, even in the absence of having the strong currency we had in 2021. What gets me excited is that the fact that all this promised growth is now being crystallized as we speak. This year alone, we've seen almost a tripling in our revenue from last year. Our first 9 months actually saw positive earnings and positive operating cash flow for the first time in our history. And so we are on the cusp of delivering that pronounced revenue growth and pronounced free cash flow growth that we've been advertising since our inception back in 2021. It's exciting that we're in the midst of that. And we think the re-rate potential inherent in delivering on that is dramatic. And you can see at trading at half times price and net asset value, that's less than half of what our immediate peers in the small cap universe are trading at. So even if we got to the median of our peers, we're looking at a doubling in our share price absent any increase in the gold price. If we're able to achieve the type of multiples that the seniors in the space are achieving, we're looking at 4 to 5 fold increase in our share price absent any increase in the gold price. And we have a quality portfolio that I would stand up against any of the seniors in the space.
Yeah, so all of that says good timing for people to be on today's call. Opportunity is right there. Company's performing on all cylinders. Gold prices cooperating. Copper prices cooperating and potentially could really help out going forward as well. Um, that appears to be the end of our questions. Unless something comes in, I will remind everybody about the company's progress and opportunities going forward. As the company has news, I will distribute press releases and analyst reports as they are available. And with that, let me thank our questions and our attendees for joining us, and thank our presenters, Jackie, David, and Peter. Wish everybody a great Thanksgiving, and perhaps, David, I'll give it to you for the final thank you and goodbye.
Well, look, thank you everybody for reaching out to us and spending some time with us. If you have any other follow-up questions, you can reach out to Jackie. She's Jackie P at goldroyalty.com. Or for the rest of us, it's first initial, last name at goldroyalty.com as well. We'd be delighted to take your questions.
Terrific. Thanks, everybody. Have a great rest of the week.
Thank you.